Hello and welcome to Zach's Investment Centre. Today we'll be covering the S&P 500 Index Fund, so let's get into it. What is the S&P 500 Index Fund? The S&P 500 is an index fund that tracks the performance of the top 500 publicly traded US companies. Let's view the list of the companies that make up the S&P 500 Index Fund. Now I'm sure a lot of these companies you'll probably be familiar with and have probably used their services before. So we have Apple, makes up 7.05% of the index fund. Microsoft makes up 6.54% of the index fund. Amazon 3.24%. NVDA 2.79%. Alphabet 2.13%. And Tesla, which was recently added, makes up 1.95% of the index fund, plus many more companies as well. Now, these top 6 companies are responsible for nearly 25% of the overall index fund. So what this means from an investment viewpoint is if these stocks have a good trading day, you can usually expect the index fund to be positive for that day. Vice versa, if these stocks have a bad trading day, you can usually expect the index fund to be in the red and negative for that day. Now let's take a look at the requirements in order for a company to be enrolled into the S&P 500 index fund. So a company will need a market cap of at least $14.5 billion. They must be a US company, a float adjusted liquidity ratio greater than or equal to 0.75, positive earnings over the most recent 4 consecutive quarters summed together, a profitable earnings report for the company's most recent quarter, and there are also liquidity requirements in order to be enrolled as well. Now let's take a look at the S&P 500's average return since it started in 1957. It did actually start in 1926, but it was only made up of 90 companies, and then in 1957 it transitioned into the 500 plus companies. The average return since 1957 of the index fund is around the 10% mark, which is quite good. For example, the most recent year being of 2023, the index funded a return of 26.29%, which is really good. Other years, such as the financial crisis of 2008, the index funded a negative minus 37% return. But as mentioned, the average since 1957 is around the 10% mark. Now let's take a look at potential returns if you were to invest your money into the S&P 500 index fund. So for example, if you were to do an initial investment of $2,000 and you were to contribute $100 per month over the course of 40 years, the total interest would be $599,979 with a total end investment of $649,979. This is based off of the 10% average return that we just discussed. Furthermore, if you wanted to invest more than this per month, for example, if you wanted to contribute $200 per month instead of $100, you could expect your total end investment potentially over the $1 million mark. This is the table showing compound interest and how your money is compounding quite quickly, which is really good. So overall, is the S&P 500 a good index fund to invest your capital? Now, I'd like to point out there is never any guarantees in the stock market and it is never risk-free. But all we could do is go off the previous data we have, and history shows since 1957, the index fund has done an average return of around 10%, which would suggest if you are looking long-term, this could be a good place to put your capital to retire a millionaire. Also, if you are new to investing, the S&P 500 index fund could be a good place to start as it's considered to be lower risk than other stock investments. That's it for this video. If you are interested in stock and crypto videos like this, hit the subscribe button. Until then, happy investing from Zach's Investment Centre.